welcome. I'm Diana Hoff with Mountain West IRA, and today we're breaking down one of the most important topics for anyone with an IRA, especially those using a self-directed IRA, and that's IRS prohibited transactions. If you've ever wondered what actions can cause an IRA to lose its tax advantage status, this is exactly what you need to understand. The goal of this video is to explain what prohibited transactions are, why the IRS has these rules, and how to think about compliance at a high level. This is educational information only, and questions about your specific situation should always be reviewed by your CPA, financial advisor, or your attorney. But let's start with the basics. A prohibited transaction is any action involving an IRA that the IRS considers improper because it benefits the account holder or another disqualified person personally instead of benefiting the IRA itself. When a prohibited transaction occurs, the IRS may treat the entire IRA as distributed as of January 1st of that year. That can result in income taxes and possible penalties. These rules apply to all IRAs, not just self-directed IRAs. A simple example would be using IRA funds to pay a personal expense. Even though the money came from your IRA, the benefit went to you personally, not the retirement account. Now you can take a distribution, that's something else entirely. And the IRS is fine with that because if you're under 59 and a half, they're going to get an early withdrawal penalty. And if it is a pre-tax account, you will pay taxes on it. So that is a way for you to personally use it. But for you to have like checkbook control and you write yourself a check, no, that is absolutely a prohibited transaction. So why does the IRS have these rules in the first place? IRAs receive special tax treatment. Contributions may be tax deductible, growth may be tax deferred, and in some cases, distributions can be tax free. Because of these benefits, the IRS restricts how IRA assets can be used. The rules are designated to ensure that IRA funds are preserved for retirement and not used for short-term personal benefit. For example, even if someone intends to repay their IRA later, using IRA money to cover a temporary personal cash shortfall can still fall into prohibited transaction territory. Next, it's important to understand who the IRS considers a disqualified person. Disqualified people include the IRA owner, their spouse, parents, grandparents, children, and grandchildren, and the spouses of those individual children and grandchildren. Certain entities that are owned or controlled by these individuals may also be disqualified. For instance, if your wife owns her own business, you can't invest in it. Now, siblings, cousins, aunts, uncles, and friends are generally not disqualified persons under IRS rules. However, you have to watch out for indirect prohibited transactions. A basic example here would be an IRA purchasing property from the account holder's parent. Even if the price seems fair, that transaction involves a disqualified person and may be prohibited. One of the most common prohibited transactions is self-dealing. Self-dealing occurs when the IRA owner personally benefits from IRA assets, either directly or indirectly. It does not require that money actually changes hands. For example, personally guaranteeing a loan to purchase an IRA investment can be considered self-dealing because the IRA owner is using personal credit to support the IRA. Another major area where people run into trouble is personal use of IRA assets. IRA assets must be held strictly for investment purposes. Personal use, even for a short period of time, may be considered a prohibited transaction. This often comes up with real estate held inside of an IRA. A straightforward example would be staying overnight in a property owned by your IRA, even if it's only for one weekend and even if you plan to reimburse the account. Absolutely, that is a prohibited transaction. Loans involving IRA are another area to be careful with. An IRA cannot lend money to a disqualified person, and it also cannot borrow money from a disqualified person. This includes informal loans or short-term advances. For example, if an IRA lends money to the account holder's child, even with a promissory note, that loan would be considered a prohibited transaction because the borrower is a disqualified person. Providing services to your IRA can also create compliance issues. In many cases, the IRS views services provided by the IRA owner as a form of personal benefit, even if no compensation is paid. A common example is an IRA owner personally performing repairs or renovations on an IRA-owned rental property. That's like sweat equity. You can't do any kind of sweat equity. Even though it might seem cost effective, the IRS can view that labor as a prohibited transaction because you are benefiting your IRA. One of the most important concepts to understand is that intent doesn't matter. A prohibited transaction can occur even if it was accidental or done without knowing the rules. The IRS focuses on what happened, not why it happened. For example, paying an IRS expense from a personal bank account without correcting it properly can still create a compliance issue, even if it was an honest mistake. Record keeping and proper structure play a huge role in avoiding prohibited transactions. IRA assets should always be kept separate from personal finances. Expenses related to IRA investments should be paid by the IRA, and income generated by IRA assets should flow directly back into the IRA. A simple example would be rent from an IRA-owned property being deposited into a personal checking account instead of directly into the IRA. Even if it's later reimbursed, that commingling can raise red flags. Finally, it helps to know where the rules come from. Prohibited transaction rules are established under the Internal Revenue Code and enforced by the IRS. These rules apply regardless of what type of assets the IRA holds or which custodian administers the account. For example, the same prohibited transaction rules apply whether an IRA owns publicly traded securities or alternative assets like real estate or private notes. To wrap this up, prohibited transactions are less about what you invest in and more about how the investment is structured and used. IRA owners are responsible for understanding and following IRS rules, and questions about these rules applying to a specific situation should always be reviewed with a qualified CPA, financial advisor, or even an attorney. Mountain West IRA is a self-directed IRA and solo 401k administrator and does not provide tax, legal, or investment advice. We love to educate, but all information shared here is for educational purposes only. Account holders are responsible for their own due diligence, and for ensuring compliance with IRS rules. If you have questions about how self-directed retirement accounts are administered, you can contact Mountain West IRA. Our contact information is in the comments. And please be sure to like and share. And if you find this video helpful, join us next time. Thank you. Bye.